Welcome to HiveMindLearning.com, where clarity meets confidence. Today, we'll demystify investing. Whether you're new to the markets or looking to level up your financial game, this guide is your blueprint. From stocks to crypto, candlestick patterns to strategies, let's build your investment intelligence. So, what is a stock? A stock represents ownership in a company. When you buy a stock, you're buying a piece of that business. As the company grows and profits, your shares can increase in value. You may also earn dividends, a share of the company's profits paid to shareholders. There are two main types of stocks. Common stocks. These give you voting rights and potential dividends. Most stocks fall into this category. Preferred stocks. These usually don't come with voting rights, but they offer fixed dividends and higher claims on assets during bankruptcy. You'll also hear terms like blue chip stocks, big, stable companies with consistent performance. Growth stocks companies expected to grow faster than the market. Dividend stocks. These provide regular income to investors. Let's explore other investment vehicles. Mutual funds pool money from multiple investors to buy a diversified portfolio. Great for beginners. Index funds are mutual funds that mirror a specific index like the S&P 500. Low-cost, passive investing. Futures are contracts to buy or sell an asset at a set price in the future. High risk, high reward. Cryptocurrency, like Bitcoin or Ethereum, is digital currency based on blockchain technology. It's decentralized, volatile, and gaining traction as an alternative investment. Technical analysis uses candlestick patterns to predict market behavior. Candlesticks show the trends in the market. If the candlestick is green, the price increased. If red, decreased. The wick is the line above or below the body of the stick. There are many different candlestick shapes that can combine to form multiple different patterns, such as shooting star, bullish/bearish engulfer, and three white knights, all of which indicate the current and past trends of the stock. This information helps us determine what the stock might do next. Here's what some common patterns mean. Doji. Doji means wait to purchase or sell until more of the pattern emerges. Hammer. Hammer indicates a rise in the stock's value and is a good time to buy into the stock. Inverted hammer. Inverted hammer. This means to wait for more of the pattern to determine the trend. It can often indicate a trend reversal. Green Marubozu. Green Marubozu means the stock opened and closed high and is trending in a pattern you will want to buy into. Red Marubozu. Red Marubozu is the opposite of green Marubozu. This indicates the stock is trending downward. Shooting star. Shooting star. This pattern indicates that selling is the better option. Bearish engulf. This pattern shows that the stock is dropping and you will want to sell. Bullish engulf. This pattern indicates an upward trend in price. This is a good indicator to purchase the stock. Bullish harami. Like bullish engulf, this indicates that you will want to buy in. Bullish means the stock is in an incline. Bearish means the stock is in a decline. Bearish harami. Bearish harami indicates that the stock is in decline and you will want to sell. Dark cloud cover. This ominous sounding pattern is a harbinger of a decline. You will want to sell. Abandoned baby. Abandoned baby usually indicates that you will want to buy in or hold off on selling. Piercing line. Piercing line indicates the stock is likely to increase in value. Purchasing is advised with this pattern. Three white knights. Three white knights are the heralds of a bullish situation. The stock shows steady increase in pricing. You will want to buy when you see this pattern. Three black crows. Three black crows are an omen of steady decline in a stock. You will want to sell when you see this pattern. Besides individual stocks, there are other vehicles to invest in the stock market. These include brokerage accounts, Roth IRAs, 401k, margin accounts, which are used for futures, and crypto exchanges if you are getting into cryptocurrency. As a note, all investing comes with some risk. Usually the higher the risk, the higher the reward. If risk isn't for you, but you want to keep up with inflation, look into treasury bonds. These are government-backed investments that are generally considered the safest investments you can make. The core principles of wealth. There are a few principles that exist no matter the vehicle you choose to invest with. The first being compound interest. Einstein was believed to have said, "Compound interest is the greatest invention of mankind." This is because compound interest helps you earn money on the money you are making, not just the money you invested. Once you have enough money invested, the compound interest is what is going to elevate you to new levels of wealth. The second principle is that time is your greatest asset. It can be difficult to make $1 million in a day, but if you slowly and steadily keep making good investments, over time you will achieve that same 1 million. If you look at a stock over a long period of time, usually you will find a steady trend upwards. Yes, there are a lot of ups and downs along the way, but the overall trend ends up being a higher value than it started with. For an example, look at Bitcoin. It used to be only worth a few cents, then it exploded when it hit $1,000 per coin. And though crypto is one of the most volatile investments, as of 2025, Bitcoin is sitting at around $100,000. If you look at the day-to-day, and even month-to-month, it will appear to be a poor-performing investment. But if you zoom out, you will see that over time, it has become a very high-performing investment. When it comes to investing, riding out the ups and downs tends to be where the most profit is. The third principle is that consistency is key. Dollar cost averaging will level out the highs and the lows. One day you might lose almost everything, but the next day might triple your investments. Consistently investing will help keep your profits trending upward. The fourth and one of the most important principles is to diversify. Each investment vehicle will fluctuate up and down. Not keeping all of your eggs in one basket will help prevent you from losing everything. The fifth principle is that you want to reinvest. Money breeds money. The more you make, the more you can reinvest, and the more compound interest will take effect. The sixth principle is to always keep learning. No one knows everything. These principles can help you avoid the major risks of investing. For instance, relying on time helps you not get focused on a single day's loss or gain. It also helps with avoiding FOMO trading. Emotional trading is how you go broke. How to make $1 million? There are many ways to make $1 million. Some methods are more risky than others. One way is to be a smart and measured investor. Invest $600 every month consistently into a fund that has at least an 8% rate of return. After 30 years, you should be close to your $1 million mark, and every year, your money will grow at an accelerated rate due to compound interest. This describes how most retirement accounts work. The next way to make $1 million is to be a more aggressive investor. Investing every month into cryptocurrency and/or speculating on futures will allow you to have much higher gains than a long-term investment. Though this comes with significantly higher risk, though it's not uncommon to average close to 10% ROI with dollar cost averaging. The third way is to invest in penny stocks and futures. You purchase a large amount of shares in a stock that only costs a penny. For example, $1,000 will get you 100,000 shares of 1-cent stocks. If that stock price goes up by even a single cent, you will double your money. That single cent increase turns your $1,000 into $2,000 because you have so many shares. Penny stocks are known to be as volatile as cryptocurrency and will fluctuate in price many times a minute. You can also sell your shares short when they reach a certain price, which allows you to make money as the stock increases and decreases. Again, this usually happens many times a minute with penny stocks. This provides a very fast way to keep doubling your money, but also is exceedingly risky. It might be a good idea to practice a strategy like this with a stock market simulator. There are tools that exist like Webull that allow you to play the stock market with simulated currency. This allows you to hone your skills before you incur any risk. Another great tool is Robinhood. Robinhood is a great platform to trade without any fees. Google and Yahoo are great tools for research into a stock. And if low risk is your thing, Acorns allows you to invest in low-risk mutual funds. Thank you for joining us today to learn about investing. Please remember to like, comment, share, and subscribe for more Hive Mind learning content.